If you've seen Cashfloat advertised with a minimum APR of 112.5%, I want to break down exactly what that means, based on my own research and experience comparing short-term personal loans. First, let's be clear. 112.5% APR is very high. This is not a regular bank loan. Cashfloat is designed for short-term borrowing, usually for people who can't access traditional credit. When I first looked at Cashfloat, what stood out was speed and accessibility, not affordability. The loan amounts are usually small, and the repayment period is short. That's important because APR looks extreme mainly because the loan isn't meant to last long. Here's the key thing most people miss. APR doesn't show what you'll actually pay short-term. What matters more is the total amount borrowed, the fixed interest charged, and how quickly you repay. For example, if you borrow a small amount and repay it on time, the total cost may be manageable. But if you miss payments or roll the loan over, costs rise very fast. From my perspective, Cashfloat is not a best loan in general. It's a last resort option. The high APR reflects higher risk, convenience, and limited access to other credit, not value. My biggest takeaway: only consider loans like this if you fully understand the repayment and already have a clear plan to pay it back on time. If you're comparing Cashfloat to other high-cost lenders, focus less on the APR headline and more on total repayment and fees. Bottom line, Cashfloat's minimum 112.5% APR is real. It's expensive, and it should be treated as short-term financial support, not long-term borrowing.